Kangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB on this Friday. I'm Andrew Gagan. I can say my own name, Andrew Gagan. It's been a long week. Thanks for joining us here at AusBiz. So, to the market, what a positive day it's been, which is probably welcome given just a bit of negativity emerging across the week, particularly, I guess, in the wake of the RBA decision, although it did leave rates on hold. A lot of speculation, in fact, the next move is going to be up, and perhaps that's going to cause a little pain, certainly among some households, next year. But let's, this is where we are finishing for the day, or pretty close to it, 1.1% higher on the CBO 200, very much driven by the materials sector. The bank's also doing well, and for the week it looks as though we're going to finish up around 0.2% higher, currently off the yearly highs of about 4.5%. I think we're away from those highs seen a couple of months ago. Let's get to the themes of the day then. ASX gains, that certainly panned out today. Great way to finish the week. Mining momentum, I was talking about the miners really driving what we're seeing on the local market today, particularly the goldies doing well, and the banks they're all up about over 1.5% at the moment as well. Tech teeters, well actually this relates to what we've seen on Wall Street. We got the Oracle result which disappointed the market. There's a lot of concern at the moment about just those AI hyperscalers overspending in terms of CapEx, and perhaps it's not going to pay off. So further concerns about the AI bubble perhaps that has developed on Wall Street. All right, let's get to the sectors of the day. Those that have moved, I mentioned the miners, so they have led from the front there with BHP is up more than 1%. Rio 2.5% higher there. Fortescue, some modest gains. Iron ore isn't really the flavour of the month at the moment. It's more about gold, silver, copper, lithium. They're all moving. South 32 and Mineral Resources rounding out that list. Elsewhere, the banks, as I mentioned, another good session there, led by Macquarie, is up over 3%. And in terms of the REITs, that is a interest rate sensitive sector, of course, and we do have some positive moves there. SGH doing best. Charter Hall also very positive. All right, let's catch up with the top stories of the day then. Treasurer Jim Chalmers approving Hanwha's plan to increase its stake in shipbuilder Austal to 19.9%, although those shares of Austal have come off. Scentre Group saying a new Dexus managed fund will buy a 25% interest in Westfield Chermside in Brisbane for about $683 million. NAB's chief executive saying Australia's economy continues to show resilience despite global headwinds. NAB holding its AGM today. And still in the banks, ANZ's former chief executive Shayne Elliott suing the bank over a issue just as far as his bonus, a multi-million-dollar bonus that, well, apparently he won't be getting. And Nickel Industries lifting its ore sales approval to 10.5 million tonnes at its flagship mine in Indonesia. Interestingly, nickel is one of those metals that has not moved this year at all. Well, let's now get to our stock of the day. I was talking about Austal there, obviously off the back of that approval by the Treasurer Jim Chalmers in terms of Hanwha raising its stake to 19.9%. Let's hear from our experts, Adam Dawes from Shaw & Partners and Mark Gardner from MPC Markets.
Thinking 40% of the stock now is out. It's not in free float, so this should then tighten everything up and move forward. So I couldn't work out why. The only thing I can think of is the reason why it's down is that it can't creep or have any other creeping provisions or take it over. So that's the only thing. But if there was to be a takeover, potentially they would take the US assets, Hanwha would take the US, and Twiggy might take the Aussie asset.
I sort of prefer, the likes of EOS and Drone Shield they can get a lot of incremental contracts and have little wins along the way, whereas shipbuilding's pretty large. So, that's more. It's more my tilt. My tilt towards a constant flow of positive news and new contracts with the others. But I don't think you'll go too far wrong with this for sure. And I'd be interested to see how they go. Probably earnings season, like middle of the year next year.
Well, let's now wrap up the week that was with our favourite Friday COB guest, Shayne Elliott, joining us from AMP. Shayne, welcome back to you. Now, come on, you must have been in your element this week. Central bank heaven, particularly we're hearing from the Fed, of course, and also from the RBA. That continues next week too. Well, we've got the likes of the ECB and Bank of England, Bank of Japan, too, expectations about what they're going to do. Well, let's start with the Fed, of course, handing down a well-expected 25 basis point cut. Question is what they do next. What do you make of what you've heard from the Fed? I guess we take a look at the dot plots and also the composition of the board, given that's going to change next year.
It certainly is. Obviously, there's a lot of uncertainty. I think the Fed was doing some insurance cuts given the weakness in job indicators. It's basically suggesting or implying that it might go on pause for a while. So we've seen 3 consecutive meetings of cuts starting in September, then October, and now. I suspect they'll probably pause for a couple of months or a couple of meetings, and then it basically depends on which way the data goes. But the overall impression from the Fed was not as hawkish as had been feared. In fact, there was some somewhat market-friendly aspects to what they said. Powell was positive on productivity. They upgraded their growth forecast. They downgraded slightly their inflation forecasts. We saw the dot plot still had 1 cut in there for next year and 1 cut in there for 2027. So you sort of got the impression that they're still leaning towards cuts. I think Powell, in fact, said at one point there that no one was considering a rate hike. So it's the opposite of Australia. It's either a hold or a cut. In Australia, we're talking about a hold or a hike. Well, that's what the governor was talking about during the week. So my impression is that overall it was fairly friendly for markets, but ultimately we're probably not going to see another move unless the data turns very bad until around May or June next year. And obviously it could well depend on the new governor. And then, of course, assuming that governor is very pro-Trump, like Kevin Hassett might turn out to be, then he would also have to convince the Fed regional presidents who tend to be more hawkish. But interestingly, on that front, there was a concern that the tenure of the Fed presidents wouldn't be renewed. It gets renewed each February for 5 years, but overnight it was renewed. So they're all locked in for 5 years now, and therefore it's going to be hard to change the composition of the FOMC that dramatically. I mean, it's possible, but going to be fairly hard. So all up, you get this impression Fed probably going to cut rates a little bit more, and that'll be supportive of markets, but there's probably not a lot in it. They're getting close to the bottom.
Well, as you say, Shayne, it is a different narrative here in Australia, isn't it, given what we heard from the RBA with talk of a potential hike. In fact, I see you sort of reference a bit of jawboning going on there from the RBA to try and keep those inflation expectations down, I guess encouraging Australians to stop spending. All well and good, but we're at Christmas, for heaven's sake.
That's right. But I do think there was jawboning in there. I mean, it probably didn't help that she was asked the same question over and over in different ways. Did you consider a cut or just consider a hike? What would happen if inflation stays high? What would you do? So her answer was always the same, basically. And that's the way the press conference worked, apart from a few left field questions. And so the message came across, which was quite hawkish. And that's why when you look at that chart there, which shows money market expectations for where the RBA cash rate will be by June next year, and then by the end of next year, and also by February, initially it turned quite hawkish. It was already quite hawkish going into the meeting, mind you. And then there was that spike above 2 hikes by the end of next year, and now we've come back a little bit. I think 1.6 hikes or something like that priced in for the end of the year. But it did seem a bit over the top in terms of hawkishness. So I thought the statement was quite reasonable in laying things out. The press conference went a bit over the top. And I'm still a little bit cautious on this. I think we've done this huge about face from where we were just a couple of months ago talking about cuts. Even if you go back to the November meeting, the RBA, I think, was still talking about one cut in there, or still allowing for one cut, and the money market was still allowing for that. And then, of course, we got the October CPI numbers, and they're the ones that changed everything dramatically. But we don't know how reliable those October CPI numbers are. And I'm also conscious, and I put this chart in my weekly notes, of auction clearance rates. So, it's probably perhaps the most timely indicator we get on the Australian economy is the auction clearance rates, because they come out every weekend. And the numbers up until last week had shown a distinct slowing. So normally you get a slowing between August and December in auction clearance rates, but in Sydney they've gone from about 73% average in August down to most recent numbers around 59%. So that's a huge turnaround, a 14-point turnaround. The seasonal downswing is about 7 points. So we've seen a far worse than normal seasonal slowing into year end. And the likelihood is that is because we've gone from peak rate cut optimism back in August, which was the high point for clearances, now to lots of pessimism and talk of rate hikes, and that's weighed on home buyers. Now, of course, people listening to this would say, well, what's wrong with that? Your house prices come down, good. But depending on your perspective on that. But the broader issue is that home buyers are just a subset of ordinary Australians. If they're feeling more cautious about things, then odds are ordinary Australians will be as well, particularly those with a mortgage, the 1/3 of households with a mortgage. They'll be feeling more cautious about things, which could put a dampener on consumer spending, even around Christmas. I know it is raining in Sydney today, so maybe that'll put a bit of a dampener, but all this talk of rate hikes probably won't be helping. So our feeling is still that it's too early to consider rate hikes. We're optimistic the next round of inflation numbers that counts, that's the December quarter, will be a little bit softer, enabling the Reserve Bank to hold, and ultimately we see them being on hold through all of next year.
Yeah, perhaps a sign of a reverse wealth effect there if homeowners feel as though perhaps the property market's going to come off. They're just a little more reticent about spending at this point. But overall, Shayne, how are you seeing the economy now? Of course, the other part of the mandate the RBA has is jobs. We did get a read on that. What did you make of those numbers?
That's a good question. It's funny, I've noticed the camera there bounces around. I got a new iPad earlier this year, and it seems to track you as you move around, which I find kind of disturbing. I'm told there's some way to turn that off, but anyway, I don't know how to do it. But in any case, I've noticed my image there keeps going up and down. But my feeling on those jobs numbers was that, yes, unemployment is still low, so they can argue the jobs market is still tight in that sense. But all of the other indicators we got in that jobs report were on the soft side. We got a fall in total employment. We got a 56,000 fall in full-time employment. Underemployment went up. Hours worked was flat. The annual rate of jobs growth and the annual rate of hours worked, as you can see in that chart there, is well and truly in a downtrend. And of course, you could argue when you look at that chart there, abstracting from the month-to-month volatility, the trend in unemployment is still up. So my take on it is those numbers are on the soft side, and when you put that together with the indication from auction clearance rates that Australians are getting a bit more cautious about things, it is another argument to leave rates on hold here. I think we tend to get this data. The data comes out, GDP numbers last week, household spending data, they're on the strong side in terms of demand in the economy, and then of course the money market gets totally convinced we're going to get lots of rate hikes next year. But there's a danger in overreacting to that. And I'm not entirely convinced that the Aussie economy is off to the races. And when you look at a comparison of cash rate expectations for Australia, we've got potentially two hikes priced in there, whereas in the US, the money market's still pricing 2 cuts in next year, more than the Fed's talking about. And it's hard to argue that the economic outlook for Australia is that much better than it is in the US. Maybe it is. Maybe I should be more patriotic towards Australia. Of course, Australia is the greatest country in the world, beyond all others, including the US, of course. That's what Trump would say. But you've got to be realistic here. And it's hard to see why the Aussie economy is going to take off to such a degree relative to the US that it's going to demand much more rapid rate hikes here, whereas the rest of the world is going sideways, or in the US still down on rates.
Oh, a very patriotic Australian, Shayne Oliver. Always terrific to round out the week with you. Enjoy the weekend. Thanks for joining us, mate.
Okay, thanks, Andrew. Thank you. Take care.
All right, let's get to the leaders and laggards then as we round out this Friday. And perhaps no surprise there, the gold miners at the top of the list. Greatland Gold up almost 10%. Genesis following. Also, the uranium miners back on the winners list there. Alcoa also. Obviously, we've seen silver at a record, copper at a record. No matter where you look at the moment in the commodities complex, it would seem. On the negative side, though, checking out those that have fallen, Catapult is perhaps belying its name there. It's actually continuing to fall this week. Lavisa also coming off the retailer there. Austal off the back of that decision by the Treasurer. Metcash and Brisbane Gomez also on the list. Checking out the small caps, Hazer up 22% in terms of its the technology company there. Energy World, Brightstar Resources in the gold space as well on the negative side. And we have seen losses for Lion Rock Minerals, Mamota, and Bathurst Resources as well. All right, let's turn to what is out overnight. So we get a read on the UK trade balance, also inflation numbers in Germany and France. Now, next week, checking out locally, we get the Westpac Consumer Confidence Index for December, US non-farm payrolls, which of course has come after that Fed decision. Always a key read on jobs out of the States, and the Central Bank Fest continues. We get decisions from the European Central Bank, Bank of England, and also the Bank of Japan. All right, let's recap then where we are finishing on this Friday, and it looks as though it's got 1.1% on the CBO 200. Similar moves we've seen on the ASX, which looks as though it's going to finish about 0.2% higher for the week. That is the COB for this Friday. Thanks for joining us.